The judge threw the book at him.
Madoff, the mastermind of
His
the
name
biggest Ponzi scheme in history, has died in prison.
In 2009,
Madoff promised
Bernie
investors
Madoff
a
Ponzi
million
after he
but it
told
was
CNN.
In the shadowy realms of financial deceit and betrayal, few names loom as ominous as that of Bernie Madoff. Behind his affable smile and impeccable facade lay a darkness that would breed one of the most infamous financial scams in history. The suspenseful dance began as Madoff employed a classic Ponzi scheme, a disguise over his main business with a promise to return more money to the investors. With each investor's contribution, he managed to pay off earlier clients, creating a deceptive aura of reality, proving that the money is worth investing with a return of twice the amount invested. The darkness behind the curtain was concealed by fabricated account statements or the dearth of ledger accounts expertly manipulated to create the illusion of wealth. The darkness of Madoff's empire was not limited to the financial realm. Family and close associates were complicit in aiding and abetting this sinister plot. His own sons, blinded by loyalty and fear, aided in divulging the scam, casting a long shadow over their family's name. But how did he even get here? This is the story of Bernie Madoff, the financial serial killer who is the architect of the biggest Ponzi scheme in history. Born on April 29, 1938 in Queens, New York, Bernard Lawrence Madoff Jr. grew up in an unassuming neighborhood far removed from the opulence that would later make a grand entry in his life. The suspenseful chapters of his early years lay hidden in the quiet streets of his hometown. Madoff's education followed a path that hinted at his future ambitions. He attended Far Rockaway High School, where his penchant for the business acumen began to emerge. There, he displayed an affinity for numbers and a fascination with the world of finance, casting an enigmatic shadow over his future. Following his high school graduation, Madoff enrolled at Hofstra University, located on Long Island. The suspenseful narrative of his life took a pivotal turn as he honed his financial skills. He graduated in 1960 with a degree in political science, a precursor to his journey into the enigmatic world of Wall Street. After completing his studies at Hofstra, Madoff went to attend Brooklyn Law School, where the allure of finance proved too irresistible. It was during these years that he dipped his toes into the stock market, and the first inklings of his dark ambitions began to surface. After completing his education at Brooklyn Law School, Madoff transitioned to the world of finance with an intensity that hinted at his future notoriety. In 1960, he founded Bernard L. Madoff Investment Securities, LLC, a firm that would later become synonymous with deception and fraud. Madoff's first notable achievement came in the form of his pioneering work in electronic trading. He introduced a groundbreaking computer system that revolutionized the way stocks were traded, setting the stage for his ascent in the financial world. This innovation, shrouded in suspense, laid the groundwork for his eventual rise to prominence. As the years passed, Madoff's investment strategy began to gain traction. He garnered a reputation for delivering consistent, impressive returns to his clients. His achievements included an unbroken streak of positive returns, reportedly averaging 10% annually, a numerical achievement that dazzled investors and obscured the shadows lurking beneath. At this, Madoff's achievements seemed unparalleled. His firm boasted an astounding $65 billion in assets under management, a numerical feat that concealed the web of deceit that sustained it. His enigmatic aura reached its zenith, captivating clients, charities, and fellow financiers alike. Madoff's OTC marketing scheme revolved around the use of a split strategy, where his left hand, representing the legitimate trading operations, was carefully separated from his right hand, concealing the fraudulent investment advisory business. This deft division of a facade deceived both clients and regulators. The suspenseful narrative unfolds with Madoff's left hand, his market-making division, which operated as a legitimate trading enterprise. This branch of his firm facilitated trades for clients, maintaining an air of respectability in the eyes of the Securities and Exchange Commission. This acted as a smokescreen to cover up the illegal dealings occurring on the other side. On the other side was Madoff's right hand, the secretive investment advisory business, where the true darkness of his scheme took root. Here, he operated a Ponzi scheme, luring unsuspecting investors with promises of steady returns, while in reality, he was simply using incoming funds to pay off earlier clients. The manipulation of SEC oversight was a key element of this treacherous act. Madoff masterfully manipulated the SEC, an agency tasked with safeguarding the integrity of the financial markets. He artfully crafted an aura of compliance and transparency, submitting false reports and manipulating documents to escape regulatory scrutiny. The suspenseful plot thickened as the very institution designed to protect investors became complicit in his deceit. As the left hand of legitimate trading operations flourished, Madoff's right hand continued its charade. The two operated in tandem, their synchronized movements creating a deception so intricate that even seasoned financial professionals were entangled in its web. The numerical allure of these ultra-high returns persuaded investors to look away from the ominous shadows lurking beneath. Behind the scenes, Madoff was simply parking their funds in an account that Chase Manhattan Bank, later named JP Morgan Chase & Company, allowing them to stagnate. Astonishingly, the banks may have reaped as much as $435 million in after-tax profit from these deposits, a numerical testament to the complicity that shrouded Madoff's scheme. When clients sought to redeem their investments, Madoff orchestrated an intricate dance of financial manipulation. He used new capital from incoming investors to fund payouts, all while perpetuating his reputation for unbelievable returns. This numerical sleight of hand allowed roughly half of Madoff's clients to cash out with apparent profits, although in reality, their gains were built upon the misfortune of others. Madoff's cunning extended to the art of grooming victims. He cultivated an aura of exclusivity, often turning prospective clients away initially, a suspenseful tactic that heightened their desire to join his ranks. But Madoff's deception wasn't limited to individual investors. His net of deceit ensnared nonprofits, including the Elie Wiesel Foundation for Peace and the global women's charity Hadassah, wiping out their funds in a cruel numerical blow. Intriguingly, Madoff leveraged his friendship with J. Ezra Merkin, an officer at Manhattan's Fifth Avenue Synagogue, to access congregants. This unholy alliance resulted in the swindling of a staggering $2.4 billion from its unsuspecting members, illustrating the depths of his treachery. While the SEC had been on his tail since 1992, their efforts were negligent. This antagonized a lot of people later on, as a big chunk of the damage could have been prevented if their efforts were rigorous enough. Apart from that, financial analyst Harry Markopolos has also been one of the earliest whistleblowers to pick on Madoff's treachery and filed a complaint to the SEC. However, his complaints were ignored by the regulatory body. Eventually, as the financial crisis of 2008 deepened, Madoff's house of cards began to teeter on the edge. Redemption requests surged, and the suspense surrounding his empire reached a fever pitch. It was in December of that year that Madoff's carefully constructed facade finally crumbled. Madoff, realizing that he could no longer maintain the illusion of prosperity, confessed to his monstrous Ponzi scheme, stunning the financial world. The revelation sent shockwaves through Wall Street and beyond, exposing the scale of deception that had blindfolded countless investors. In the aftermath of his confession, the dark cloud of suspicion extended to Madoff's own family. His two sons, Andrew and Mark, were implicated in their father's schemes. They had worked for the firm for years and had an intimate knowledge of the inner workings of the operation. Tragically, Mark Madoff couldn't bear the weight of his family's infamy. In December 2012, just 2 years after the scandal erupted, he took his own life in his Manhattan apartment, a chilling twist in the tale that added to the suspense surrounding the Madoff family's complicity. As Bernie Madoff faced the consequences of his crime, he was sentenced to 150 years in prison, a numerical reflection of the severity of his actions. He began serving his sentence at the Butner Federal Correctional Complex in North Carolina. In April 2021, another shocking twist occurred. Madoff was found dead in his prison cell at the age of 82. The circumstances of his death remain shrouded in mystery, leading to speculation and unanswered questions about how one of the most notorious financial criminals in history had met his end. The aftermath of Madoff's scheme extended beyond mere numbers. It left a scar on the financial industry, leading to increased scrutiny and regulatory reforms aimed at preventing similar catastrophes in the future. Madoff's scheme left thousands of investors in financial ruin. They had entrusted their fortunes to a man whose numerical promises had dazzled them. The estimated losses were monumental, reaching as high as $65 billion, a numerical testament to the enormity of the deception. The scheme also had international ramifications, as victims spanned the globe. Numerical data shows that investors from over 100 countries were affected, underscoring the truly global reach of his deception. The suspenseful story of Bernie Madoff's Ponzi scheme and its aftermath serves as a chilling reminder of the destructive power of financial deception. While some restitution was achieved through legal proceedings and compensation efforts, the numerical toll it extracted on countless lives continues to reverberate, leaving a haunting legacy in the annals of finance.